Most people think investing means buying stocks, but there is another giant part of the money world where investors do something simpler. They lend money, collect interest, and wait to be paid back. That is the basic idea behind bonds. A bond is basically an IOU. When a government, city, or company needs money, it can borrow from investors by issuing bonds. The investor gives money today. The borrower promises to pay interest along the way and return the original amount later. This is the first big difference from stocks. When you buy a stock, you own a small slice of a company. When you buy a corporate bond, you do not own the company. You are lending to it. You are more like a lender than a business owner. Borrowers use bonds to raise large amounts of money. A company might need cash to build factories, refinance old debt, or fund operations. A government might borrow to pay for projects and public spending. Instead of getting one huge bank loan, the borrower can borrow from many investors at once. Every bond has a few important terms. It has a face value, which is the amount due at the end. It has a coupon, which is the interest payment. It has a maturity date, which is when the loan is scheduled to be repaid. Face value is sometimes called par value or principal. Imagine a bond with a face value of $1,000. If the borrower does what it promised, that $1,000 is the amount paid back when the bond matures. The coupon is the interest the bond pays. If a $1,000 bond has a 5% annual coupon, it pays $50 of interest per year. Many traditional bonds split that interest into two payments, but the core idea is just regular interest. Maturity is the finish line of the bond. A short-term bond might mature soon. A long-term bond might mature many years from now. At maturity, the borrower is expected to repay the face value, assuming it is not defaulted. Picture this. A city issues a $1,000 bond to build a bridge. You buy it. The city pays you interest each year. At the maturity date, the city returns the $1,000. The bridge is the project, but the bond is the loan. Bonds can come from different borrowers. National governments issue government bonds. Cities and states issue municipal bonds. Companies issue corporate bonds. The basic structure is similar, but the risks, tax treatment, and interest rates can be very different. Investors buy bonds for income, stability, and planning. A bond can provide scheduled payments and a known maturity date. That can be useful for people who want less day-to-day uncertainty than stocks, although bonds are not risk-free. If this kind of simple money explanation helps, consider subscribing. The goal here is to make finance feel less mysterious, one concept at a time. Now let us get to the part that confuses almost everyone at first, which is bond yield. Beginners often think the coupon and the yield are the same thing. Sometimes they are close, but they are not always the same. The coupon is based on the bond's face value. The yield depends on the price you actually pay for the bond. If you pay $1,000 for a $1,000 bond with a 5% coupon, the math feels simple. You receive $50 per year. Your coupon rate is 5%, and your current income compared with your purchase price is also 5%. Now imagine the same bond is selling for $900. It still pays $50 per year because the coupon was set when the bond was issued. But $50 on a $900 purchase price is a higher income rate than 5%. The opposite can also happen. If investors are willing to pay $1,100 for that same bond, it still pays $50 per year. Now the income rate on the price paid is lower. The bond did not change, but the price changed. Yield to maturity goes one step deeper. It estimates the annual return if you buy the bond at today's price, receive the payments, and hold it until maturity. It includes the interest payments and any gain or loss from being repaid at face value. The most famous rule in bonds is that prices and yields usually move in opposite directions. When a bond's price goes up, its yield goes down. When a bond's price goes down, its yield goes up. It is like a seesaw. Think about an older bond paying 4%. If new bonds now offer 6%, investors will prefer the new bonds. To make the older bond attractive, its price may need to fall. A lower price helps its yield compete with newer bonds. The same logic works in reverse. If an older bond pays 6% and new bonds now offer 4%, that older bond becomes more attractive. Investors may bid up its price because its coupon is better than what new bonds are offering. If you hold an individual bond to maturity and the borrower pays as promised, the changing market price may not matter as much. You keep collecting the scheduled interest, then receive the face value at the end. But if you sell early, the market price matters a lot. The biggest promise in a bond is repayment. Default risk is the risk that the borrower cannot make the interest payments or return the principal. Safer borrowers can usually borrow at lower interest rates. Riskier borrowers usually must offer higher yields to attract lenders. Credit ratings try to summarize default risk. They are opinions about a borrower's ability to repay. Higher-rated bonds are often called investment grade. Lower-rated bonds may offer higher yields, but that higher yield is compensation for taking more credit risk. Even if a borrower is financially strong, a bond can still lose market value before maturity. That is interest rate risk. When market rates rise, older bonds with lower coupons often become less valuable. This risk is usually larger for bonds with longer maturities. Duration is a way to estimate how sensitive a bond is to interest rate changes. You do not need the formula to understand the idea. Longer duration usually means the bond price moves more when interest rates change. Shorter duration usually means less price movement. Bonds also face inflation risk. If a bond pays fixed dollars every year, those dollars may buy less in the future if prices rise. A bond can pay exactly what it promised and still leave the investor with weaker purchasing power. There is another quiet risk called reinvestment risk. When you receive interest payments, you may want to invest them again. If interest rates are lower at that time, the new return available on those payments may be lower than what you hoped. Liquidity means how easily you can sell something at a fair price. Some bonds trade actively, others may be harder to sell quickly. If a bond is less liquid, an investor might have to accept a lower price to get out fast. Some bonds are callable. That means the borrower has the right to repay the bond early under certain conditions. This can be good for the borrower when rates fall, but less ideal for the investor because the higher-paying bond may disappear. Not all bonds make regular coupon payments. A zero-coupon bond is usually bought below face value and pays the face value at maturity. The investor's return comes from the difference between the lower purchase price and the amount received later. Many people do not buy individual bonds. They buy bond funds or bond ETFs. A fund owns many bonds inside one investment. This can add diversification and convenience, but the fund usually does not have one single maturity date like an individual bond. Because a bond fund keeps buying and selling bonds, its price can rise or fall over time. Investors may receive income, but the share price can change. This is why a bond fund is not the same as holding one bond until it matures. Bonds can feel similar to savings products because they involve interest, but they are not the same. A bond is an investment that can change in market value and can carry default risk. Bank deposits and bonds have different protections, risks, and uses. Stocks sit below bonds in the basic business structure. If a company does well, stockholders may benefit from growth. Bondholders usually just receive the promised payments. If a company gets into trouble, bondholders generally have a stronger legal claim than stockholders, but they can still lose money. People often call bonds conservative, and many bonds are less volatile than stocks. But conservative does not mean guaranteed. The bond's price can move. The borrower can weaken. Inflation can reduce purchasing power. The key is knowing which risk you are actually taking. One common approach is a bond ladder. Instead of putting all the money into one maturity date, an investor spreads bonds across several maturities. As each bond matures, the money can be used or reinvested. This can help manage timing and interest rate uncertainty. Here is the clean way to remember bonds. A bond is a loan. The coupon is the interest promise. The maturity is the repayment date. The price is what investors pay in the market. The yield is the return implied by that price and the future payments. Before buying any bond or bond fund, beginners should understand the borrower, the maturity, the yield, the credit risk, and the interest rate risk. A higher yield is not free money. It is usually a signal that some kind of risk is being priced in. Bonds matter because they connect everyday investors with the borrowing needs of governments and companies. They help fund roads, schools, businesses, and public spending. For investors, they can provide income and planning tools, as long as the risks are understood clearly. If you still have a question about bonds, coupon rates, yields, or bond funds, leave it in the comments. You can also suggest the next money topic you want explained in plain English. The more specific your question is, the easier it is to answer clearly.